Hello and welcome to KYC 101. This channel is for those of you who are interested in understanding more about KYC and anti-money laundering processes within banking or the financial industry. A short summary about my background and experiences. I have worked within the AML space for the past 13 years, having worked with various consultancies providing AML advice for 14 Tier 1 banks and financial institutions. I have written 4 AML procedures which were implemented into various banks, trained over 200 analysts globally and created various risk assessment tools for AML analysis. As my experiences have mainly been in the UK, these videos will detail UK regulatory requirements which are governed by the Financial Conduct Authority. What is KYC? KYC stands for Know Your Customer, or Know Your Client. Why is it required? As a firm offering financial products and services, it will need to be authorized and supervised by a financial regulator within the country of its operation. The KYC process within firms are developed to help adhere to these regulations and identify if any of the customers they have within their organization are conducting illegal or unusual business activities. Another term commonly used is CDD. This stands for Customer Due Diligence. Some firms may prefer to use this term instead of KYC. These are interchangeable. The KYC process will help identify 1. Who the prospective customer is. 2. What type of business they are conducting. 3. If there are any potential risks in having the prospect as a customer of the firm. In the United Kingdom, the Financial Conduct Authority is a financial regulatory body that operates independently of the UK government. It's there to set out the regulatory requirements for the financial sector in order to protect and improve the UK's economy. In the UK, nearly all financial service activities must be authorised by the Financial Conduct Authority, FCA. Firms such as banks, financial institutions, building societies, credit unions, insurance companies, and major investment firms are regulated and supervised. This also includes individuals that are involved with regulated activities, such as independent financial advisors. FCA supervises roughly 58,000 financial services firms and financial markets in the UK. Other countries around the world will also have their own supervisory bodies which will govern how firms are to operate within that country and may have their own KYC, or money laundering requirements. What are the main components of KYC? The purpose of conducting KYC assessments is to gather an understanding of the prospective customer and to assess how they operate as a business. What does the prospect want this account for? What products and services do they require? Do they meet the capital requirements for the firm? What kind of business are they conducting? Will their account be linked to operations within higher-risk countries? Are there any adverse media information linked to the company? Who are the beneficial owners and shareholders of the prospect, and do they have any adverse media information on them? If the prospect cannot be on board as a customer due to some concerns, should the firm escalate it to the National Crime Agency, NCA? When is KYC conducted? There are generally 3 scenarios in where a KYC review is conducted. 1. At the time of onboarding, a new customer, checks will need to be conducted before a prospective customer can open an account or conduct new business. This is to verify that the prospect is suitable to open the account with the firm and the risks tolerances in having them as a customer are acceptable. 2. Regular reviews, or rolling reviews of existing clients, usually conducted every few years. Refreshing the KYC file of an existing customer is vital to the firm. This is to reconfirm that there are no increased risks in maintaining the relationship. Some areas to look into is if the customer's business model has changed. If the shareholders have changed. If the company is going in a new direction, will there be any increased risk to our firm's reputation in having this customer? 3. Event-driven or material change review can occur at any point of the relationship. If the firm notices a change in an existing customer's profile, maybe something has come up in the news, there's a new company takeover, the shareholders have changed, there's adverse news in relation to money laundering concerns, then a refresh of the KYC file will need to be conducted, and this may impact, or even increase the customer's risk profile. KYC risk categories. Within a firm, there are generally a few different risk categories which can be implemented to classify its customers. Doing this will help the ongoing maintenance or re-reviews of the customer. Low-risk customer, 3-year re-review, dependent on the firm's risk tolerances. These are generally companies which are listed on a recognized stock exchange, a regulated financial services firm, or a company with a transparent ownership structure and business model, where the information is publicly available. Medium-risk customer, 2-year re-review. Generally these are smaller private companies, within a lower medium-risk jurisdiction, having low or no adverse media. High-risk customer, 1-year re-review. These are generally companies which operate in high-risk jurisdictions, the ownership structure is opaque, there's adverse media on the company, or its shareholders, there may be ongoing concerns with how it operates as a business. Low-risk KYC characteristics. To categorize a customer as low risk, the firm must consider various factors within the KYC review process. The lower risk reasons could be: 1. Operates in a low-risk country. 2. It is regulated company within an equivalent, low-risk, jurisdiction. 3. It is a company listed on an approved recognized stock exchange within an equivalent, low-risk, jurisdiction. 4. Other low-risk entity types such as government department, or central bank. 5. No, or low adverse news connected with the entity. Maybe the adverse media has been cleared, or does not present any money laundering concerns. 6. Information on the company is publicly available and easily obtainable. Shareholders' beneficial owners are publicly known. General KYC tasks. 1. Ownership dilution to 25%, information usually publicly available. 2. Information can be easily sourced from regulators' website, or from a recognized stock exchange. 3. Financial statements, or audited reports which are independently audited and publicly available. 4. No requirement for identification verification, ID&V. 5. Screening of the company. Medium-risk KYC characteristics. To categorize a customer as medium risk, the firm must consider various factors within the KYC review process. The medium risk reasons could be: 1. Operates in a medium risk country. 2. It is a private company and information is not publicly available. 3. It is not a regulated firm, or it is not listed on an approved stock exchange within an equivalent low-risk jurisdiction. 4. There may be some adverse news connected with the company. 5. The shareholders, or beneficial owners may have links to higher-risk jurisdictions, or high-risk business activities. General KYC tasks. 1. Ownership dilution to 25%. 2. Identification of directors, shareholders, and ultimate beneficial owners. 3. Company formation documents, ID, and verification, ID&V, of shareholders and ultimate beneficial owners. 4. Financial statements, or financial reports are not publicly available and need to be obtained. 5. Screening of the company, directors, shareholders, and ultimate beneficial owners. High-risk KYC characteristics. To categorize a customer as high risk, the firm must consider various factors within the KYC review process. The reasons could be: 1. Operates in a high or medium risk country. 2. Obscure or unclear ownership structure. 3. Not regulated or listed on an approved stock exchange. 4. Adverse news connected with the entity. 5. Operations in a non-equivalent jurisdiction, i.e. high-risk countries. 6. Shareholders or beneficial owners are linked to high-risk business types, or have adverse media. 7. Dealing in high-risk business activities such as oil, construction, charities, or gambling. Customer is not forthcoming in providing information. High-risk KYC characteristics. General KYC tasks. 1. Ownership dilution to 10%. 2. Identification of directors, shareholders, and ultimate beneficial owners. 3. Company formation documents (ID) and verification (ID and V) of shareholders and ultimate beneficial owners needs to be certified by a local independent auditor, accountant, notary public. 4. Financial statements reports are not publicly available. They need to be obtained and independently verified by a local independent auditor, accountant, notary public. 5. Screening of the company, directors, shareholders, and ultimate beneficial owners. 6. Front office head of department review and KYC sign-off. 7. Compliance department, or money laundering reporting officer, MLO, review and KYC sign-off. Here is a layout of the general KYC team structure within financial institutions. Moving on to the next topic, money laundering. Money laundering is the process by which illegally obtained money or assets are exchanged for clean money or assets with no obvious link to their criminal origins. These can take place in many forms. Some examples are: criminal enterprises, illegal funds from drugs or extortion, white-collar crime, illegal funds from insider trading, tax fraud, tax evasion, or market manipulation. Political figures, the misappropriation of government-owned funds for personal gain. There are 3 stages to money laundering: 1. Placement. 2. Layering. 3. Integration. Placement. Assets generated from crime are placed in the financial system. This is the point when the proceeds of crime are most apparent and at risk of detection. Example: depositing cash into a bank account. Layering. Layering obscures the origin of illicit funds by passing money through complex transactions. These often involve different entities such as companies or trusts and can take place in multiple jurisdictions around the globe. Example: transferring money to a bank account in another name. Integration. The investment of funds in legitimate businesses or other forms of investments. Example: buying property, setting up a trust, acquiring a company. Having a balanced risk-based approach within a firm will help identify and assess the risks associated with a prospective customer. Correctly categorizing the risk for a certain customer will in turn help manage future KYC re-reviews and the amount of time needed to be spent in updating the information. Resource can also be used more effectively on focusing on the higher priority, or high-risk customers, who may be more inclined in committing money laundering offenses. Implementing controls to deter money laundering and terrorist financing means applying appropriate due diligence when entering into or reviewing a business relationship. Having the right controls in place will deter some money launderers from trying to open or apply for a new account. They may not be able to provide the required company formation documents, or the ID and V for the beneficial owners. Having these minimum KYC requirements will help prevent the wrong types of customers from being onboarded. What risks can be presented by the customer? New customers carrying out large one-off transactions. Customers engaged in a business which involves significant amounts of cash. Complex ownership structures with the potential to conceal underlying beneficiaries. An individual meeting the definition of a politically exposed persons, PEP. Customers based in, or conducting business in or through a high-risk jurisdiction, or a jurisdiction with known higher levels of corruption, organized crime or drug production. The transactions that do not make commercial sense, if a client closes an investment before maturity, or rapid movement of funds. What risks can be presented by a customer's behavior? An unwillingness or inability to produce KYC evidence when requested, especially around the beneficial ownership. Where a customer may be acting on behalf of another person, an unwillingness to identify the third party. Where there is no commercial rationale for the relationship. Situations where the source of funds and source of wealth cannot be easily verified. What risks can be presented by existing customers? A sudden increase in transactional activity from an existing customer. Uncharacteristic transactions not in keeping with the customer's known activities. Rapid movements of funds, they come in and leave the account almost instantly. Peaks of activity at particular locations or at particular times, structured payments. The transaction did not make commercial or business sense, for example, an oil company sending funds to a political individual. The customer is not able or unwilling to provide a justification for the transaction. The ownership structure of the company has changed, but the customer is not able to provide or confirm who the new beneficial owner details. Responsibilities within KYC. The KYC team have a responsibility to report internally to compliance, or the MLR if they know or suspect any individual or entity may be engaged in money laundering or terrorist financing. In the regulated sector, tipping off an individual or customer that an internal money laundering investigation is being conducted or carried out is a criminal offense. It can incur consequences of up to 5 years imprisonment, a fine or both. If you enjoyed the video, please leave a like, subscribe or share my channel with your friends. Press the bell icon to get new video updates, it really means a lot. See you next time.